Hi everyone and welcome to the YouTube channel of Being ACCA. This is Tushita Gupta, ACCA affiliate, bringing to you people the debrief of the FM Pre-December 2025 mock exam. Now this mock exam is super important if you're somebody who's appearing for the FM paper in the December 2025 sitting. The reason being this exam will help you find out how much ready you are for your final exam, what all mistakes could you potentially make. So the best use of this resource will be, firstly, without watching these videos, without going forward, firstly, time yourself for 3 entire hours and solve this paper on your own in a timed environment, in an environment where you do not have any distractions, any noises, so that you are able to recreate an exam kind of a setting. After you're done with that, then you watch these videos. Now, these debrief videos are also going to be in a particular sequence. So for you people's ease and the way you can navigate through all of these videos easily, what I'm doing is I'm dividing this mock into different videos. Section A, this is the video where we will be solving section A of this paper. Next video, we will break it down case study by case study. So section B will have 3 videos, 1 case study each, and then ultimately section C will have 2 videos, both of the case studies in one video each. So this is how I am planning to bifurcate the videos of this mock for you, so that whatever point you were stuck at, you can simply go and navigate to that particular question without wasting a lot of your time. Because I know that during this time, especially when exams are barely a few days away, this is something, time is of the essence now. So this is really important that I bifurcate it accordingly so that you do not waste a lot of your time and you simply navigate to the areas where you wish to. So here in this video, like I mentioned, we will be discussing the section A of this particular paper. So without any further ado, let's get started. So section A, we all know there are going to be 15 objective case studies. Each of them are going to carry 2 marks, with 30 marks of total being in part of section A. So here is the first question in front of you. Calculate a company's cash operating cycle using the working capital ratios rounded to the nearest day. So they are giving me the extracts from the financial statements of a company, revenue, cost of sales, inventory, receivables, payables, and they want me to assume a 360-day year. Now I know when they are asking me to calculate my cash operating cycle, I know that the cash operating cycle formula which I'm supposed to use is receivable days plus the inventory days minus the payable days. So these are the 3 numbers which I need for the working of my final answer of the cash operating cycle. Now, how do we calculate the receivable days? The value is receivable collection period will be equal to the balance of the receivables divided by the total of the credit sales multiplied by 360, because the question has told me to use 360. Now they are telling me the amount of the receivables is $420 million, and then for my denominator I need the credit revenue. So how can I find out the credit revenue? They are telling me that out of a revenue of 3,800 million, 10% are cash sales. That means how much part of it is going to be credit sales? Remainder 90% would be credit sales. So 3,800 multiplied by 0.9. This is the amount of credit sales which the business has at the moment. So what we do is we take our numerator as 420 divided by 3420 worth of the credit sales and multiply this figure with 360. So this gives me roughly 44.2 days, or I can just round it off to 1 day and I can take my answer as 44 days for the receivable. Then I will move towards the inventory days calculation. So inventory's value is given to me as $350 million, and then they are telling me that cost of sales are directly given to me. So what I'll do is I'll use the formula for inventory days. I know that the formula is inventory value divided by the purchases that I've done, the cost of sales that I've incurred, which is 2,700 million. So I'll take the inventories of 350 divided by 2,700 times 360. This will give me my answer in terms of the number of days. So roughly I can say that this is equal to 47 days. So plus 47. And from this, I need to take away the payable days. So for payables, again, I know the formula is going to be the trade payables balance of 250 divided by how many purchases have I done. So 80% of 2700 represents the purchases. So 80% of 2700 is going to be 2160. So now I know my numerator as well as denominator. 250 divided by 2160 times 360 is going to give me 42 days, which I take to pay my payables. So I will subtract 42 from this figure. That means my answer will be 44 plus 47 minus 42. 44 plus 47 minus 42. So this gives me 49 days, which I will pick as the cash operating cycle for a company. Now proceeding to the second question, which of the following is or are weaknesses in using the financial statements to value an unlisted business? So we are using the financial statements of the business to find out the value of the business, and we have to select which of them will be the weaknesses or the limitations. So if you have a look at the first statement, financial statements are governed by financial regulation. That means we have different rules and requirements. We have IAS, we have IFRSs, with which the companies have to follow those rules, and then they have to prepare those statements. So this is not a weakness, this is rather a strength, so that the company's financial statements can be free from any material misstatements or error. Another statement that it makes is financial statements do not represent the future performance. Now this is absolutely right. When I am using a financial statement, this is a data which pertains to the past. When the year comes to an end, that is when we prepare the financial statements. So they tell me about what has happened in the past, but the statements do not tell me what will happen in the future. So second statement is definitely one of the weaknesses. If I am using financial statements to value an unlisted business, it will tell me all of the things that have happened in the past, but I do not get to know how is the future looking like for this company that I'm trying to value. And then the third statement says financial statements are produced on an annual basis. Now again, this is another limitation. Why? Because if they are prepared annually, I do not get to know the information on time. Only when the year has passed, then I get to know the information. So this is also a weakness, because maybe something important has happened. I'll only get to know that at the end of the year when the statements are produced. So 2 and 3, both statements represent the weaknesses of the usage of financial statements when I'm trying to value an unlisted business. Now moving ahead to the third question, Stone Company is expecting to deposit $25 million in 3 months' time. The deposit will be for a 4-month period. Stone Company is concerned that the interest rates could fall over the next 3 months. So it wants to fix the rate of interest now with a forward rate agreement, and they have obtained the following quotes. So there's one FRA that's 3v4 and another is 3v7. So I need to start after 3 months, and then it will be for a 4-month period. So 3 plus 4, that means I need to use a 3v7 FRA agreement. So this is the one which is going to be relevant for me. Now, assuming that the interest rate is 4.3% in 3 months' time, I am supposed to tell what will be the financial settlement under the FRA. So what happens is you've locked these rates. Now, these are 2 rates given to you. If you are a company who is depositing in the bank has offered you these 2 rates. Always remember that the dealer, the bank always takes the advantage. So if you are depositing, they will give you lesser interest. If you are borrowing, they will ask you for more interest. So here you're on the deposit side, the bank will pay you 4.7% or 5%, always the lesser value, that is 4.7%. So that means bank has promised to pay you 4.7%, but in real life, the interest rates have fallen down to 4.3%. That means bank is going to give you the difference. What will be the difference amount? 4.7% minus 4.3%. This is the difference converted to percentage terms. In percentage, this is the difference. Now, this is for always the interest rates on FRAs are quoted for a whole year. Now, my deposit is only for a period of 4 months. So, I will also convert it to a 4-month rate into 4 divided by 12. So, this is the percentage for the duration period. And then $25 million is the worth of my amount. So, 25 followed by 6 zeros. This is the differential which the bank is going to pay to me, that is Stone Company. So 33,333. This is what my final answer is going to look like. Now moving towards the fourth question, select the type of financial market appropriate to each of the company's needs. Ambi company needs to convert foreign currency into domestic currency. So do they go to a forex market or do they go to a euro currency market? Definitely when you want to get the currency converted, you go to the foreign exchange market. When do you go to euro currency markets? Internationally, there are two kinds of markets if you want to borrow money, euro currency and euro bond. Euro currency is for short term, euro bond is for long term borrowings. Then you have the second statement, DIL company needs to issue new long term loan notes. Long term loan notes, money market or capital market? Money market is short term, capital market is long term. So DIL company will go to the capital market. Benji company needs to issue new ordinary shares. New ordinary shares, primary or secondary? New will always be in the primary market. Then you talk about Carlo company needs to purchase short-term over-the-counter derivatives. So do you go to a primary money market or do you people go to a secondary money market? Secondary markets are regulated exchanges where everything happens in a fixed quantity. If you want something that is over the term, over the counter, then you have to go to a primary money market. Moving ahead to the fifth question now, Buckland Marsh Company has a current market value of $58 million and has recently paid a dividend of $5 million. The dividend payout ratio is 70% and the return on equity is 20%. You're supposed to find out the cost of equity of Buckland Marsh Company to the nearest percentage. So what I'll do is I'll open my formula sheet here. I can see that the information has been given with wherein I have to find out the growth rate as well. So to find out my cost of equity, this is the formula that I'll need. I need the D0, I need 1 plus G, and I need the price. So I know the dividend of 5 million, I know the total market price, I just need to find out the growth rate. So how do I calculate the growth rate? I'm given with the payout ratio, I'm given with the return on equity. So having a few hints at what the information is telling me, I know that this is the Gordon's growth model. Payout ratio is given to me as 70%. Gordon's growth model wants me to take the retention ratio into the return of equity. If payout ratio is 70%, that means retention ratio will be 100 minus 70, that is 30%. So how do I find out my growth rate? My growth rate will be equal to 30%, that is my retention ratio, so 0.3 into 20%, that is the return on the equity. So that means my growth rate is 6%. Now I put the growth rate in the formula that has been given to me, D0 into 1 plus G divided by P0. So let's take how much is the D0? D0 is 5 million into 1 plus, we've just calculated the growth rate to be 6%. So into 1.06. This is my numerator divided by P0. P0 is the total market cap, which is 58. So this is the first half of my working, and then I will add the growth rate separately. If you have a look at the formula here, I will add the growth rate separately plus G over here at the end. So plus growth rate I had just calculated as 0.06. Add both of these figures together, multiply by 100 to get your answer in a percentage. And if you want to give it to the nearest percentage, you will get your answer as 15%. So 15% is what I will enter over here, and then I will proceed further. Moving ahead to the sixth question now. which two of the following are true in this particular situation? The finance director of Tracker Company is analyzing the yield curve in the euro market to select a suitable financing strategy. He observes that the yield curve has recently changed from a normal yield curve to an inverted yield curve. So usually, guys, if you talk about a normal yield curve is always upward sloping. Why? Because the more the duration, more will be the risk, so more return is also demanded by the investors. If my yield curve is inverted, that means it will be sloping downwards. That means if I am going towards the longer term, the interest rates are going to be lesser. So let's see which two statements will be correct. Bonds with a long-term maturity term will have a lower return. This is absolutely right. Think again. If you talk about the normal situation, what happens normally? In a normal yield curve, you find that it is upward sloping. Why? Because if, let's suppose, somebody comes to you and asks you for a loan for 1 year versus they ask you for a loan for 15 years. So if you are giving them a amount of loan for 15 years, you will be worried that lots of things can change over a period of 15 years. Risk is high if you compare 1 year with 15 years. So you would want a higher return also to be compensated for that. So this is what happens under a normal yield curve scenario. But here the yield curve has become inverted. Inverted means it will be opposite. Earlier, if it is upward sloping, now it is going to be downward sloping. That means earlier when on longer maturity, I was getting more interest or I had to pay more interest. Here with long-term maturity, you will have the opposite. That means lesser interest. That means lesser return. So first statement is one of the correct answers. Let's see. The second one is Tracker Company is exposed to rising interest rates. If it was rising, it would not have been an inverted yield curve. The change would have been beneficial for Tracker Company if it had issued long-term fixed rate debt before the inversion. So before the inversion, if you would have gone for a long-term debt, you would have had to pay a higher interest rate. Whereas now after inversion, on long-term maturity, you have to pay lower interest rates. So no, it would not have been beneficial. So third statement is also incorrect. Last statement says that the raising euro bonds financing in the euro currency has become more attractive. When you are doing euro bonds means something which will remain in your business for a long-term time. So now that the yield curve has become inverted, long-term maturity comes with lesser interest. So definitely raising euro bonds has become more attractive because euro bonds are long-term in nature and long-term debt has become cheaper because the yield curve has been inverted. So statement A and D, these are the two correct statements which we will be picking for question number 6. Proceeding now to the 7th question. Which of the following is an illustration of the principal agent problem? First is suppliers cutting their costs by using cheaper materials to keep their prices low. This is not a principal agent problem. Second is directors avoiding debt finance because lower interest payments increase their job security. Now this is definitely a principal agent problem example. How? Directors are the agents of whom? The agents of shareholders. So rather than thinking about what will be the best for the shareholders, they are thinking about their own selves. This is exactly what we have studied as the concept of the principal agent problem or the agency problem. Third is stakeholder groups disagreeing over dividend policy. So here stakeholders amongst themselves, if they fight, there's no principal agent relationship because all shareholders are principals. And then lastly, the stock market exerting pressure on companies to achieve short-term profits. Here also there is no principal agent relationship being involved. Only statement 2 talks about a principal agent relationship, and we can clearly see a conflict that the agents, rather than thinking what's the best for the principal, they are thinking about their own selves. That is, they want to increase their job security. Moving forward to the 8th question now. A project has average estimated cash flows of $3,000 per year with an initial investment of $9,000 with no residual value. Depreciation is straight line and the project has a 6-year lifespan. The company has a target return on capital employed of 28% and a target payback period of 2.5 years. ROCE is based on the average investment. So you are supposed to say that under which which investment appraisal method or methods using the company's targets will the project be accepted? So first, let's talk about the payback period. So I am getting 9,000 that is going out of my pocket today, and I'm getting $3,000 per year as the estimated average cash flows. So that means if I find out the payback period for this one, 9,000, if it comes back to me 3,000 every year, that means it is going to take me 3 years to recover my initial investment back, whereas my target is 2.5 years. So that means with respect to the payback period method, will we be accepting this project? No, we want the money back in 2.5. How much time does this project take? It is taking 3 years. So this is something which will not work as per the payback period method. Then let's find out the ROCE of this particular investment. So if I want to look at the ROCE, I will use the ROCE formula, which wants me to take the profit and divide that by the average investment. So here, because the question has specifically mentioned that ROCE is supposed to be based on the average investment. So firstly, talking about my denominator, 9,000 is the opening value. What is the definition of average investment? Opening value plus scrap value divided by 2. So here there is no residual value. That means scrap value is 0. Divide this whole figure by 2. Your average investment is $4,500. Now this is our denominator. We are still yet to work our numerator. For numerator, I want to take the average annual profit. So here I have cash flows of 3,000. Cash flow and profit are not the same. I have to convert this cash flow into profit. This is the cash flow before any other expenses in my books of accounts. So in the books of accounts, I also charge depreciation. With respect to depreciation, they are telling me it's a straight line basis over a period of 6 years. So $9,000 that I depreciate for 6 years, that means $1,500 every year will be the depreciation. So $3,000 is my average annual profit. Subtract the depreciation, that means every year I will be left with profits of $1,500 divided by the average investment of 4,500, which gives me 33% roughly. If I convert it to a percentage, 33.33% as the return on capital employed that is being given to me by this project. And in the company, my target is 28%. So I aim to achieve 28% return, but I am getting 33%. So that means with the ROCE approach, I am definitely going to accept this particular project. So ROCE only will be my final answer. Moving ahead to question number 9 now. Which one of the following performance measures would best fit with effectiveness in a value for money audit? Now, before I had to think which out of these options will be measured as per effectiveness, recall what are the 3 E's that you have in the value for money model. You have economy, you have efficiency, and then you have effectiveness. Economy is all about minimizing the cost of your inputs. Efficiency is all about maximizing your output to input ratio. More output and lesser input. So maximize your output to input ratio. And then effectiveness is about achievement of the final objective. Now let's have a look at all of these statements. Average hours to train a dog to the Guide Me certification standards. Your final objective is basically to train dogs for the blind people. So if you are taking more hours, average hours, that does not really measure your effectiveness. Your average goal is to train lots and lots of dogs for the blind. Second is number of dogs awarded with the certification. That means these dogs are properly trained. They are certified. So this measures your end result. How many dogs were you able to train for the blind people? That is what measures your final outcome. Average expenditure on each successfully trained dog. So this will be a little bit about your efficiency aspect. And then lastly, average hours worked by each dog trainer. This is also monitoring how good you are utilizing your resources. So this is also not a part of effectiveness. Rather, this will be efficiency. So it will be option B, which we will select as our final answer. Now, moving ahead to the 10th question, Ella Company has decided to invest in a new machine which has a 7-year lifespan and has no expected residual value. The machine can be purchased outright for $80,000 using an 8% loan. Alternatively, it can be leased for 7 years by paying annual rental payments of $14,983, which must be paid at the end of each year. That means for all of the years 1 till 7, I will be paying this much amount of money. Now, whenever you people have a choice between doing a buy or a lease, you draw a comparison between both of the costs. So if you go ahead with the loan, right now itself $80,000 will go out of your pocket. But if you go for a lease payment, then every year some amount of money is going to be paid by you for a fixed number of years. So now let me find out how much money does it mean in today's terms, which I will be paying for the lease payments. So I know that I will be making the same amount of payment, 14,983, over a period of 7 years. So what I will do is I'll go to the annuity tables. 8% is the cost of my loan. So I go to the annuity table. This is the place where I have the numbers written for 8%. 8% for a period of 7 years. 5.206 is the factor. So what I do is I take 5.206, multiply this with 14,983. That means all the payments that I will make over the period of 7 years, this is how much this money is worth in today's terms. So either I pay 80,000 today or I pay $78,001 today. What do you think? Which option is the company going to prefer? Will it be the buy option or the lease option? Buy option is 80,000, lease option is 78. So as a company, you always want to minimize your cost. So it will be beneficial to go ahead with the lease option. Let's see what are the statements telling us. Machine should be purchased because it has a lower overall cost. No. Should not agree to either because it will result in negative NPV. No. Machine should be leased because this option has a lower overall cost than purchasing outright. This is what my final answer is going to look like. Now let's have a look at the other one. The machine should be purchased because lease rental payments are higher than the interest payments. No, interest payments we've already considered when we took 8% as the part of the cost of capital. Now moving forward to question number 11. A company is planning a major investment in a new manufacturing unit in the next year. Due to the recent concerns that inflation is too high, the government has unexpectedly announced an increase in the interest rate. So they were thinking to invest, but then inflation is too high in the economy. So to control the inflation, the government has increased the interest rates. Let's see which two of the following statements concerning the impact of the government's decision is true. First statement is the company's cost of capital will decrease. Guys, now interest rates are high in the economy. If you are thinking of a new investment, maybe some of it will come from a loan. If the interest rates are higher, you will get higher rate of loan, higher rate of interest that you have to pay on the loan. That means your KD will increase. So if your KD increases, that means the cost of capital will also increase. So the first statement cannot be your answer. Second statement says that this is an example of an expansionary monetary policy. When you want to control inflation, it is a deflationary policy, contractionary policy, and expansionary is the exact opposite of that. When I try to increase the demand, when there is too less of inflation, too less of demand in the economy, then I want people to spend more money. That is when I lower the interest rates, I lower the tax rates. That kind of a policy is called as the expansionary policy. And here also, this is something which the government is doing about the interest rates. So we will say that because the interest rates have been hiked, we will say that this is, rather than expansionary, this is a contractionary policy. So second statement can also not be true. Third is that the demand for the products of the company may decrease. Now, this is something which can happen. How? Not everyone has the money. Some people borrow money from the banks. So if you go to borrow money from the banks, interest rates are higher. So you'll have to pay as a customer, you'll have to bear higher costs if you want to get something on credit. So that means buying will become expensive for me as a customer. So I'll choose not to demand a lot of quantity. Last is that the NPV of the investment will be lower than initially expected. So as we were discussing, because of the increase in the interest rates, my cost of capital can also go up. So earlier, let's suppose my cost of capital was 8%, but now it is 10%. So when you calculate the NPV at a higher discount rate now, definitely the NPV will fall than initially you were thinking. So both options C and D will be the correct statements over here. Now proceeding to the question number 12 now. WaveNet company is planning a 1-for-4 rights issue. The value of the rights has been calculated as $0.5 per existing share. WaveNet company's market price is currently $8 per share. You people are supposed to first calculate the TERP and then the rights issue price. So the formula that we people have learned over here is basically TERP is the difference between market price before the rights issue happened minus the value of a right per existing share. So you're given with the market price currently, that is $8, minus the value of rights is given to you. So 8 minus 0.5 will give you $7.50, which is the TERP for this particular share. And lastly, you have to tell the rights issue price also. So for the rights issue price, basically we have to take TERP, and from that you have to subtract the value of a right. So to find out the value of a right, basically you're getting 0.5 per share. Now, how many shares did a person initially have? 4 shares. That means total the shareholder is going to be having a benefit of 0.5 into 4, which is equal to $2. So that means the rights issue price is going to be TRP minus $2. So 7.5 minus 2, which will give you 7.5 minus 2 will give you $5.50. So 5.5 is what you pick over here. Proceeding to question number 13 now. Teled company is a listed company which has 400 million ordinary shares in issue. Yesterday, the ordinary share price closed at $5. 2 days earlier, the board of directors approved the launch of 2 new innovative products, but this has not yet been publicly announced. Product A has an NPV of $40 million. The decision to launch product A will be announced publicly tomorrow. Product B has an NPV of $160 million. The decision to launch product B will be announced publicly this morning. Assume all other things are equal and the capital markets believe the projected NPVs. Both products will be financed using internally generated funds. What will be the ordinary share price at the end of today if the capital market is part 1 semi-strong efficient and secondly if it is strong form efficient. So in a semi-strong efficient market, any news that is publicly available gets absorbed into the price that is prevailing on the stock market. So we are supposed to say what price will it be end of today. So that means something was told to them publicly. Product A, you will tell them tomorrow. Product B, you have told in the morning. So that means till the end of today, the shareholders will be reacting to this news. How will they react? They will know that company's worth will increase by $160 million. So out of 160 total that the company will earn, that will be shared among 400 million people. That means one shareholder is going to gain $0.4. Right now the price is 5 plus 0.4 is going to make it $5.4, which I see nowhere but option 3. Let's also discuss how we will do it for the strong form efficient market. Strong form efficient markets are those markets where they already know these markets do not react as per the news. Anything which is not yet made public, that is also already absorbed in the share price. So when the company is deciding to launch these things, the share prices have already adapted that. So yesterday the share price that was $5, this price has already included everything that the company was just about to make public, because we have studied conceptually in a strong form market both presented news also and unpresented news also is already reflected in the share price. So when shareholders will get to know about product B, this news was already adapted into the share price because it is a strong firm efficient market. So there is not going to be any change in the share price. It was at $5 and it will still remain at $5. Similarly, when publicly about product A will be announced tomorrow, then also nothing will happen to the price because a strong firm market already includes both public as well as unpublished information. Moving ahead to the second last question now from section A of our paper. Which of the following statements concerning the traditional theory of capital structure is correct? So just to have a quick recap of the traditional theory, what you people study as a part of it is initially the cost of equity will rise slowly. As gearing increases to high levels, the cost of equity will start to increase. Similarly with cost of debt, initially you get cheaper debt at lower levels, but when you breach a certain level, cost of debt also starts to increase. So initially your WACC overall falls down with low levels of debt, but when you go to high levels of debt, the cost of capital, weighted average cost of capital also starts to increase. So there's one particular point which will be the optimal capital structure that you can find out using no specific formula, because traditional theory does not give you any formula. It says if you want to find out your optimal capital structure, you can simply use a hit and trial method, trial and error method. So let's read the statements and now find out which one of them is correct. First is that there's an optimal structure of capital structure for a company where the market value is maximized. This is absolutely right. We were just discussing that there's one point where WACC is the minimum. So where WACC is the minimum, the market value is the maximum. Second is buying and selling of shares by arbitrageurs ensures that the share prices are consistent with the theory. This is not something that we've studied as a part of the traditional theory. Third is the cost of equity of a company decreases as the capital gearing increases. How will KE decrease? No, it increases because the financial risk is now increasing for the equity shareholders. Cost of debt is constant. No, cost of debt is constant or it's constant till a certain point of time, but after gearing increases to high levels, the cost of debt also starts to increase. So option A is going to be the right answer to pick over here. That is in line with our traditional theory of capital structure. Now heading towards the last question pertaining to the section A of our paper. Which two of the following statements concerning the interest rate risk management method of smoothing are true? Firstly, recollect guys, what exactly is the method of smoothing? So smoothing is basically where what I do is I take a mix of, when it comes to the debt, it comes to the loans that I'm taking. Some loan I take on a fixed rate, some loan I take on a variable or a floating rate. So this is the technique of smoothing. Now what will happen is, if let's suppose the interest rates go up, at least some part of my debt was at a fixed interest rate, I'll have to pay higher interest only on the part of loan which I had taken as variable. If vice versa happens, if the interest rates fall down, some part of the variable loan that was there, I will gain a benefit because interest rates have fallen, so I'll have to pay lesser interest. But again, some part of my debt was fixed debt. So that means even if the interest rates have fallen down in the market, the fixed debt which I have promised, that is something which I'll have to continue to pay even if the market interest rates have fallen down. So basically, in this method of smoothing gives me a little bit of protection in case of upside or a downside. Now let's talk about the first statement. The debt portfolio will consist of a mixture of floating and fixed rate debt. This is absolutely right. So this is one of the statements which will be my answer. Second is interest payments will still increase if the interest rate rises. That is definitely true because only some part of my debt was fixed, other part was variable also. So where I was having variable interest rates, because the interest rate has risen, I'll have to pay more interest specifically on that part of my floating debt. Third statement says investments with a fixed cash flow will be financed with a fixed rate debt. That's not the concept of smoothing. Full benefit will be obtained from a fall in interest rates. No, only part benefit because part of my debt is fixed, part of my debt is floating. And lastly says that the net effect will be an interest payment which is fixed overall. That's also not true, because the net effect will keep on changing as per what is happening, because I am having some part of fixed debt and some part of floating rate debt. So first two statements are the one which we can say that with respect to the risk management method of smoothing, these are the two statements which are consistent as per this particular technique. So with this, we have come to an end to section A of our FM pre-December 2025 mock exam. In the next video, I'll see you people with the section B first case study, and in the videos to come, we'll solve this entire mock together. So I hope that these videos have been helpful to you. I was able to contribute to your preparation in any manner, and I really wish you all the very best for your final exams.